Most people don't realize this, but the economy you learned about in school stopped existing sometime around 1971, and nobody bothered to update the textbooks. Look, I'm not here to feed you the same recycled talking points you get from financial news networks. What I'm about to walk you through is how money actually moves through the system right now, in 2025, and why the rules governing gold and the dollar bear almost no resemblance to what your grandparents experienced. Let's start with a story that'll make this concrete. In 1924, 100 years ago, a New York banker named Charles worked at J.P. Morgan. Every single day he'd handle gold certificates, real paper backed by real metal sitting in vaults. When someone deposited money, Charles understood exactly what was happening. Gold moved from one ledger to another. When international trade happened, ships literally transported gold bars across oceans. The money supply couldn't just expand because some committee decided it should. Physical reality constrained the system. Charles had a grandson. Let's call him Michael. Michael became a banker too, started in 1974 at Chase Manhattan. By then, everything had changed, but most people were still operating with Charles's mental model. Michael's first week on the job, he asked his supervisor where they kept the gold backing the deposits. The supervisor laughed. Not a polite chuckle, a genuine, almost pitying laugh. "Kid," the supervisor said, "that's not how this works anymore." This reveals something important. The fundamental architecture of money shifted, but the language we use to talk about it stayed frozen in amber. Well, let me explain what actually happened. For most of human history, money was a physical thing: gold, silver, copper, whatever. Then we got clever and created paper certificates representing that physical thing. Then we got even more clever and decided we didn't need the physical thing at all. The paper itself could be money, as long as everyone agreed to treat it that way. The technical term is fiat currency, money by decree. It exists because the government says it exists and will accept it for taxes. That's it. No gold, no silver. Just agreement backed by legal tender laws and the implicit threat of state violence if you don't participate. Now, here's where it gets interesting. When you operate on a gold standard, like we mostly did until 1933 domestically and 1971 internationally, the money supply faces natural constraints. You can't print more money than you have gold to back it. This creates certain economic dynamics. Limited money supply means deflation becomes a real possibility. It means governments can't easily inflate away their debt. It means international trade balances through actual gold transfers. Think about that for a second. If France ran a trade deficit with the United States in 1924, gold literally flowed from French vaults to American vaults. This couldn't continue indefinitely. Eventually, France would run out of gold, which would force economic adjustments. Their currency would devalue against gold, making their exports cheaper and imports more expensive, naturally correcting the imbalance. It was a self-regulating system, sort of like a thermostat. Painful sometimes, absolutely. The Great Depression proved that gold standard constraints could amplify economic contractions. But it was self-regulating. This leads us to an important point. What replaced that system operates on completely different principles, and most people are still using the old framework to understand new realities. After 1971, when Nixon closed the gold window and ended international dollar-gold convertibility, we entered what I call the trust me bro era of monetary policy. The dollar's value no longer derives from a fixed relationship to gold. Instead, it derives from a complex interaction of factors: the Fed's credibility, U.S. military, and economic power, the dollar's role as global reserve currency, energy markets priced in dollars, and faith in U.S. institutions. Notice how squishy all that sounds compared to 1 ounce of gold equals $35? The Federal Reserve can now expand the money supply essentially at will. They create money through several mechanisms, but the main one is buying assets, usually government bonds, from banks. The Fed credits the bank's account with new money that didn't exist before. Boom, money created from nothing. In 2020 and 2021, the Fed's balance sheet exploded from about $4 trillion to $9 trillion. Think about that. $5 trillion created in roughly 18 months. Under a gold standard, that would have required finding and mining an absolutely staggering amount of gold. Under the current system, just keystrokes on a computer. Now, the mainstream narrative will tell you this is sophisticated modern monetary policy. The central bank using its tools to provide liquidity and stabilize the economy during a crisis. And there's some truth to that. But here's what they don't emphasize. Every dollar created dilutes every existing dollar's purchasing power, assuming the supply of goods and services doesn't expand equally. This is just math. More money chasing the same stuff means higher prices. You felt this in 2022 and 2023. Grocery bills that seemed to jump 30 or 40%. The Fed's official inflation numbers said 8, maybe 9%. Your actual experience said something very different. That disconnect? That's the gap between statistical models and reality. This is the moment where you need to understand that official inflation measures are designed to understate real inflation for political and fiscal reasons. The CPI calculation has been modified repeatedly over the decades. Substitution. If steak gets expensive, they assume you switch to chicken, so they measure chicken prices instead. Hedonics. Your new laptop costs the same as your old one, but has better specs, so they record that as a price decrease. Housing costs measured through owner's equivalent rent, rather than actual home prices. I'm not saying these adjustments are completely unreasonable, but I am saying they systematically bias the number downward. If we calculated inflation using the methodology from 1980, current inflation would be approximately twice the official number. Just look up shadow stats if you want to see this breakdown. Why does this matter for you? Because your wages, your social security, your raises, they're all benchmarked to official inflation. If official inflation understates reality by half, you're losing purchasing power every year that you think you're keeping pace. This changes everything. Now let's talk about gold specifically, because gold's role has transformed completely over the past century. In 1924, gold was money. You could walk into a bank with a $20 gold coin and it was worth $20. You could trade it for goods directly. The government's paper currency was explicitly a claim check on gold held in vaults. Today, gold is an asset, a commodity. It trades in markets like wheat or copper. Its price in dollars fluctuates constantly. You can't walk into Starbucks and buy coffee with a gold coin. The legal tender is fiat currency, dollars that have no intrinsic value beyond social agreement. But here's the fascinating part. Even though gold is no longer officially money, central banks still hoard it. The United States claims to hold about 8,100 tons of gold. Germany holds about 3,300 tons. The IMF holds about 2,800 tons. In fact, central banks globally have been net buyers of gold for over a decade now. In 2022, central banks purchased over 100 tons, the highest annual purchase in over 50 years. Why? If gold is just another commodity, why do central banks accumulate it? Why not accumulate oil or lithium or semiconductor chips, things with actual industrial utility? The answer reveals the fundamental tension in the modern monetary system. Gold remains the ultimate money of last resort. It's nobody's liability. If every government collapsed tomorrow, if every bank failed, if the entire fiat system imploded, gold would still have value. It's been valued for 5,000 years across every civilization. That track record matters. Central banks know this. They publicly downplay gold's importance while privately accumulating it. This tells you something. Specifically, it tells you that the people running the system don't fully trust the system. Think about that for a second. Now, individuals and institutions buy gold for different reasons today than they did 100 years ago. In 1924, you owned gold because it was money. You owned it the way you own dollars in your checking account today, as a medium of exchange and store of value within the functioning system. In 2025, you own gold because you distrust the system. You own it as insurance against currency debasement, against inflation, against potential systemic failure. It's not a medium of exchange. Try buying groceries with gold coins and watch the confusion. It's a store of value outside the system. This represents a complete philosophical inversion. The dollar's transformation is equally dramatic, just in the opposite direction. 100 years ago, the dollar was a unit of measurement for gold. Saying you had $20 was just a convenient way of saying you had a specific quantity of gold, about 1 ounce. Today, the dollar is the measuring stick for everything else, including gold. Gold's price is quoted in dollars. Oil's price is in dollars. International trade settlement happens predominantly in dollars. The dollar achieved this dominance through several mechanisms, some economic, some geopolitical. First, after World War II, the United States held the majority of global gold reserves and ran the only major industrial economy that was not bombed to rubble. The Bretton Woods Agreement made the dollar the global reserve currency, backed by gold at $35 per ounce, with other currencies pegging to the dollar. Second, the petrodollar system emerged in the 1970s. After Nixon ended gold convertibility, the U.S. made arrangements with Saudi Arabia and other major oil producers. They would price oil exclusively in dollars, and in exchange, the U.S. would provide military protection and support. This meant every country needing oil needed dollars, creating permanent global dollar demand. Third, U.S. financial markets became the deepest and most liquid in the world. If you're a foreign central bank with reserves to park somewhere safe, U.S. Treasury bonds are the default option. This creates a reinforcing cycle. Dollar dominance leads to demand for dollar-denominated assets, which reinforces dollar dominance. But here's what's changing right now in real time. That dollar dominance is eroding, slowly, unevenly, but unmistakably. China and Russia have been settling bilateral trade in their own currencies, bypassing the dollar. The BRICS nations are discussing creating alternative payment systems. Saudi Arabia is now accepting yuan for oil sales to China. The percentage of global reserves held in dollars has declined from about 70% in 2000 to about 58% today. These shifts are happening gradually enough that most people don't notice. But gradually, then suddenly, that's how these transitions tend to occur. This leads us to an important point. We might be living through a slow-motion monetary regime change, and most people won't realize it until it's already happened. Let me give you a practical example of what this means. In 2000, you could buy an ounce of gold for about $280. Today, it's trading around $2,000 to $2,100, depending on the day. That's about a 7x increase. The mainstream interpretation, gold has increased in value. The alternative interpretation, the dollar has decreased in value by approximately 85% relative to gold. Same phenomenon, completely different framing. And the framing matters because it affects how you think about wealth preservation. If gold went up, that's a nice investment return. Good job on picking a winning asset. If the dollar went down, that's a systematic erosion of your purchasing power that you need to actively defend against. See the difference? Everything in economics is measured in some unit. When that unit itself is unstable, all your measurements become unreliable. It's like trying to measure distance with a rubber ruler that stretches and shrinks. Now let's address something important. I'm not here to tell you gold is the perfect investment or that the dollar is doomed. Simple narratives are usually wrong. Gold produces no cash flow, it pays no dividends or interest, it just sits there. From a pure financial perspective, over long periods, productive assets like businesses tend to outperform commodities. And the dollar, despite its erosion relative to gold, remains the dominant global currency. The US military, the depth of US financial markets, the network effects of dollar usage, these create enormous structural support. What I am telling you is this. The relationship between gold, the dollar, and the economy has fundamentally transformed over the past 100 years, and operating with outdated mental models will cost you. Your grandfather could save in dollars for 40 years and reasonably expect those dollars to maintain purchasing power. You cannot. The system changed. One thing that really stands out to me, your grandfather saw gold as money. You should see it as insurance against monetary mismanagement. Your grandfather lived in an era where money supply was constrained by physical reality. You live in an era where it's constrained only by political will and central bank credibility. These are different worlds, operating on different rules. This is the moment where you need to make a decision about how you navigate this environment. Some people go full gold bug. They put significant portions of their wealth into physical gold and silver, preparing for systemic collapse. They might be right eventually, but eventually can take decades and opportunity cost is real. Some people ignore all of this and keep everything in cash and bonds, trusting the system completely. They're exposing themselves to inflation risk and currency debasement that could evaporate decades of savings. The rational middle path involves understanding the forces at play and diversifying accordingly. Hold some productive assets, businesses, stocks, real estate, things that generate cash flow and can potentially raise prices with inflation. Hold some monetary insurance, gold, maybe Bitcoin if you understand it, assets that exist outside the traditional financial system. Hold some cash for liquidity and opportunities. And most importantly, understand that the purchasing power of your cash is systematically eroding, so leaving too much in low-yielding savings is a guaranteed real loss. Let me give you some specific numbers to think about. From 1913, when the Federal Reserve was created, to 2024, the dollar has lost approximately 97% of its purchasing power. What cost $1 in 1913 costs about $33 today. That's an average annual inflation rate of about 2%. Doesn't sound too bad when you say it that way, right? But compound that over a lifetime. If you're 30 years old today and live to 85, that's 55 years. At 3% annual inflation, prices will increase by a factor of 5, 1x during your remaining lifetime. That thing that costs $100 today will cost $510 when you're 85. Now, if your income and assets grow at least 3% annually, you keep pace. But most people, as income growth slows or stops after age 50 or 60, and if you're living on fixed income in retirement, you're watching your purchasing power evaporate in real time. This is why your grandparents could retire on a pension and Social Security, and you probably can't. The rules changed. Think about that for a second. The system isn't designed to help you preserve wealth. It's designed to finance government spending through inflation, a hidden tax that requires no legislation and creates no direct political accountability. When the government runs a $1 trillion deficit and the Fed buys those bonds with newly created money, that's effectively printing money to pay for spending. The cost gets distributed across everyone holding dollars through decreased purchasing power. It's taxation through inflation, and it's invisible to most people. Now, what about the economy more broadly? The modern economy operates on debt to a degree that would be unrecognizable 100 years ago. Total U.S. debt, government, corporate, household combined, is approximately 350% of GDP. In 1924, total debt was roughly 200% of GDP, and that was considered high. This debt is only sustainable because interest rates have been artificially suppressed for decades. When the Fed held rates near zero from 2008 to 2021, governments and corporations gorged on cheap debt. But here's the problem. All that debt needs to be rolled over periodically. And when it gets rolled over at higher rates, the interest payments explode. The US government is now paying over $1 trillion annually just on interest on the national debt. That's more than we spend on defense, more than we spend on Medicare. It's the fastest growing part of the federal budget. This creates a fiscal doom loop. Higher interest payments mean larger deficits. Larger deficits mean more borrowing. More borrowing means higher interest payments. There are only three ways out. 1, cut spending dramatically. Politically impossible. Try cutting Social Security or Medicare and see what happens. 2, raise taxes dramatically. Also politically fraught, and there are limits to how much you can extract without destroying economic growth. 3, inflate away the debt. Print money, create inflation, and pay back creditors with devalued currency. Guess which option is most likely? This is why the relationship between gold and the dollar matters so much going forward. We are almost certainly entering a period of higher structural inflation as governments attempt to inflate away unsustainable debt burdens. Gold historically performs well in high inflation environments because it maintains purchasing power when fiat currencies don't. The dollar's value will likely continue eroding in real terms, even if it maintains or even strengthens relative to other fiat currencies. Understanding this isn't about pessimism. It's about adapting your strategy to the actual rules of the game rather than the rules you wish existed. Let me bring this full circle with our banker characters. Charles, working in 1924, operated in a constrained system with clear rules. Money was gold or gold-backed paper. The supply couldn't arbitrarily expand. International imbalances self-corrected through gold flows. The system had serious flaws. It amplified deflation. It made responding to crises difficult, but it was comprehensible. Michael, starting in 1974, entered a completely different system. Money was whatever the government said it was. The supply could expand infinitely, constrained only by inflation fears. International imbalances could persist indefinitely. The system was flexible, responsive, and built on trust in central bank competence. If Michael had a grandson starting banking today, let's call him James, he'd be operating in a system that has pushed the fiat logic to its absolute limit. James would see central banks that created trillions during COVID with a few computer keystrokes. He'd see national debts that can never be repaid in real terms. He'd see inflation returning after decades of perceived stability. He'd see growing questions about dollar dominance and the emergence of alternative monetary systems. The rules keep changing. The game keeps evolving. So what does all this mean for you? It means you need to update your mental models. Stop thinking about money as a stable measuring stick. It's not. It's a variable that is being actively manipulated by central banks with incentives that don't align with yours. Stop thinking about saving as simply accumulating dollars in a bank account. In a high inflation environment, that's the equivalent of putting your wealth in a leaky bucket. Start thinking about preserving purchasing power across different asset classes. Some productive assets, some monetary insurance, some liquidity. Start understanding that the financial advice that worked for previous generations might not work for you because the underlying system has fundamentally changed. And most importantly, understand that gold and the dollar aren't what they were 100 years ago. They've swapped roles in some ways, maintained roles in others, and exist in a relationship that's far more complex than the simple narratives suggest. Gold isn't going to make you rich, but it might preserve your wealth when fiat currencies fail to. The dollar isn't going to collapse tomorrow, but it is going to lose purchasing.